Hello, my name's Nathan Led. I'm a member of the research team at Morgans, and in this video I'd like to touch on my reporting season previews for the key infrastructure stocks listed on the ASX. All right, I'm just going to touch on 4 stocks that I think are interesting for the August reporting season. Those are Transurban, APA Group, Aurizon, and a little bit separate to the infrastructure space, but what I call, I suppose, waste logistics, is Cleanaway. So for Transurban and APA Group, 2 very important infrastructure stocks on the market. So Transurban owns a number of, well, basically all of the toll roads around Australia, and also some toll roads over in North America. And APA Group, around about 90% of its earnings comes from its gas, pipeline and distribution networks, as well as also earnings from power generation and electricity transmission. So I think in some ways, some of the dynamics for Transurban and APA are very similar for this reporting season. They will both provide first-time distribution guidance for FY25. For APA, I'm expecting very minimal growth, maybe 1 cent per share growth. So it's looking at 57 cents per share. So that puts it on a yield in the mid 7%, sort of, or into the 7% cash range. For Transurban, I'm expecting around about 11% underlying growth in distribution. So that'll take it to a bit over 64 cents a share. If I look at both these businesses, what they're both facing is quite large increases in costs coming through their cost base. For APA, that's coming from increases in investment in technology, in corporate, in sustaining CapEx, in foundation CapEx. For Transurban, it's cost growth across their business, both at the asset level and at the company level. Both these businesses also have been very clever about being able to term out their interest rate risk exposure. But over time, we are going to see, as they refinance debt and as they raise new debt, that the cost of debt that they face is actually going to increase. And also what they are both facing is, over coming years, that their tax payable will also increase. So all these are putting headwinds into their free cash flow growth and therefore their distribution growth. So personally, I have a view on valuation for both these stocks, which is below the consensus and certainly below where the share prices are at the moment. So a more, I suppose, bearish view on both those stocks. Other 2 sort of key stocks that I think are really interesting out of that list is Aurizon and Cleanaway. So for Aurizon, some quite strong earnings growth coming through. So Aurizon, a bit over 50% of the business is their below rail track infrastructure that they own in central Queensland, coal infrastructure track. They also operate above rail operations in both coal haulage and non-coal bulk hauls. So for Aurizon, quite strong growth coming through. What we should see with the result is 2 interesting elements. We should see a first time EBITDA guidance for FY25, and we should see also the first time that they have adjusted their capital management settings since they bought the One Rail acquisition or One Rail business a number of years ago. They have promised to the market that they will be reviewing both their dividend payout ranges and also the potential for buyback. So I think their payout ratio will actually increase from 75 to 80%. That is less than what consensus is actually targeting, which is a mid to high 80% payout. But I think that offsetting that lower payout will also be buybacks. And I've assumed about a $200 million buyback may be coming through. So I think the market will be quite fixated on the earnings direction as well as the capital management for that business. Cleanaway, I have an ad rating on the stock. The management has quite clearly laid out midterm or FY26 EBIT aspirations, and they're quite strong. They're targeting over 450 mil of EBIT, or earnings before interest and tax. That compares to around about sort of $300 million in FY23. So the progression of that growth from 300 into over 450 is quite important. I think it's basically laying out a progression which is showing some very strong earnings growth. What I think will be interesting for the market will be the operating cash flow that is actually dropping out of the business, and I think maybe they might disappoint the market on that front through both higher landfill remediation rectification spend as well as a ramp up in tax payable. But on the flip side, I think their maintenance CapEx intensity is actually going to drop based on what they have previously informed the market. So I think that is a quite important thing when you have a business that is growing quite quickly. If it can also reduce its maintenance CapEx, it's a very strong thing. So I think there are elements that the market will also be looking for Cleanaway.